Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending October 21st, 2022. Looking at the market indexes for the week, the TSX, S&P 500, NASDAQ, and Russell 2000 are all up somewhat for the week. Oil was down and gold was up. We had a Canadian CPI news release on Wednesday, so the consumer price index was somewhat flat. The core CPI, which strips out the volatile energy and food components, year over year, we got 6% inflation. The forecast, however, was only 5.6, so we missed on that. The previous month's year over year was also 6%. The month over month was 0.4%. The previous month's was 0%, so we were actually worse than August. When you look at the headline overall inflation that includes food and energy, month over month increase was 0.1%. The forecast was a negative 0.1%, so we also missed on that. And the previous month's month over month was negative 0.3%. And year over year for September for the headline inflation was 6.9%. The forecast was 6.8, and the previous month's year over year was 7.0%. So we were a little bit better than the previous month, but worse than expected. So next week's Wednesday's Bank of Canada meeting will likely have a 0.75% increase for us, taking us to 4%. Note that some of the inflation is thanks to the stronger US dollar that is making US dollar denominated things more expensive for everyone else. The market worries continue to be inflation, rising interest rates, and the high US dollar, which is causing things to be expensive for everybody other than Americans and is lowering foreign revenues for American companies. There is an expectation of a recession in 2023, which is also lowering the price of commodities. A widespread slowdown is expected, but arguably already priced into the market. The central banks will only quote unquote pivot to cutting interest rates if we get into a serious recession. We are now in the neutral range for interest rates. The market expecting interest rate cuts is somewhat optimistic. In the US, earnings for Q3 have been better than feared so far, beating expectations, but keep in mind the expectations have come down a lot, so the earnings are frequently below last year's. Bank of America beat on revenues and earnings Monday morning, where the banks are losing on investment banking activities due to low confidence in the market and economic outlook, and wealth management because of the lower fees from lower account balances. They are making up in trading revenue, where the market volatility is bringing more trading volume, and a very healthy interest rate spread where they borrow and what they pay on your deposits. British issues are slowly getting resolved, and the US dollar weakened at the start of the week to improve earnings potential for foreign companies or income from foreign sources for local companies, and therefore their stock prices, giving people confidence to get into risk assets. A weaker US dollar would be one of the factors bringing down commodity prices, therefore inflation. Real estate in Canada is also weak, bringing down inflation from that source. As the economy slows, that also puts pressure on inflation. Note that these are all forward-looking indicators, unlike the backward-looking CPI numbers that the central banks look at. There is also some wage inflation, however, it is slowing. Canadian Business Sentiment Survey came out on Monday, and business sentiment is poor, worst since the start of the pandemic, worrying about demand, fears of a slowdown, rising inflation in their costs, and their ability to keep up with rising borrowing costs are the other worries for businesses. One major apprehension fueling the fear of a recession is wage growth, potentially leading to a wage inflation spiral, a spiral that central banks would need to shoot down with sustained interest rate hikes, potentially triggering that recession everyone's afraid of. The concern over wage inflation is abating, thankfully. Wages are increasing less, and they were never increasing as fast as inflation. Wages are part of the inflation picture, however, and are putting some pressure on inflation. Wages are simply catching up with inflation, and in the short term, wages are still lagging inflation. Turning to China, worries about China invading Taiwan and the fact that it makes the majority of the world's semiconductors is causing tensions in the market. The Chinese government and Xi's speeches indicate a peaceful inclusion, especially since the US would interfere in an invasion. The US, meanwhile, is looking at reshoring semiconductor manufacturing from Taiwan, but it won't be easy, cheap, nor fast. China is still sticking to its zero COVID policy, which is making things move slowly there. Inventories are still showing an elevated level at a lot of companies, and these companies are turning to quote unquote just in case inventories. Consumers may begin to spend less as the economy slows and credit becomes more expensive. Looking at next week, companies reporting on Tuesday, we have Alphabet, Visa, Coca-Cola, UPS, SAP, Lockheed Martin, Raytheon, Spotify. Wednesday, we have Microsoft, Meta, Canadian Pacific, Boeing, General Dynamics, Kraft, KLA Corp, Crescent Point, and Thursday, we have Apple, Amazon, MasterCard, Samsung, Northrop Grumman, Shopify, Tech Resources, Shaw, Cameco, Whitecap Resources, and on Friday, we have Exxon, Chevron, Volkswagen, and Fortis. The economic events of next week, well, the big one is on Wednesday when Bank of Canada is releasing its interest rate decision. US oil information is on Wednesday as well. Thursday is US GDP and jobless claims, and Friday is Canada's GDP. That concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.